Hello, Happy New Year, and welcome to Stockcharts TV. I'm John Kosar of Asbury Research. Today I'm going to talk to you about what we see in terms of danger and opportunity as we look ahead through the first quarter of this new year. Today is January 13th. The title of today's presentation is "The Market is in the midst of a tactical correction right now and vulnerable to a deeper decline." First, let's take a minute just to review what we were looking at the last time that I was with you. That was on October the 8th of last year. And the first thing, and really the title that I had mentioned, let's go back and look at the S&P 500 here, is that there was a lot of risk-reward opportunity as we saw it. And here's why. When I was with you the last time, we were right about here. So here we were sitting right on some support that we had been holding for a couple of weeks based on the July and August lows of last year, and also the 21-day moving average, which is a monthly moving average. There's 21 business days in a month. It's an important average to us in terms of the research we do here at Asbury. So you can see not a lot of risk underneath this support and pretty much open-ended in terms of upside. The S&P rose by another 6% into the December 6th high. The next thing that we talked about was the Nasdaq Composite Index. That's the more broad of the two Nasdaqs. Here's the comp here. And what we talked about was this big sideways churning pattern. It's called a symmetrical triangle in terms of the chart pattern's name. We broke out of the pattern on September the 18th. I was with you right about here, so not too much higher than when we broke out. I said the upside target on this thing was 20,250. That would remain valid as long as we stayed up above the 50-day moving average, which is the blue line here. It didn't quite get the 20,250, but it got really close, within a couple hundred points, about middle of December, and after we had another 11% rise from October the 8th. The third one that we looked at was Alphabet. So here's Google here. The reason it was important to us, last year was driven largely by a handful of AI-related mega cap tech stocks. Google was one of them. So when I was with you was right about here. Here's October of last year. The reason I brought this one out is because we had this big support level here from going back to November of 2021. You can see we tested it again here as a resistance level in latter part, or actually early part of 2024. And then we tested it as support here in September, and we rose back up to the 200-day moving average. So I was with you here. There wasn't a lot of risk down here on this idea, and open-ended upside. So Google, since then, rose an additional 24% into the high that we made in the early part of December, early to middle part of December. So those were three keys from last time I was with you. A lot of these technical targets have been met now. So now let's take a look forward and see what I think we should be paying attention to through the first quarter, and what we think is important. The first thing that's important to us right now is what's the internal health of the market. And for that, we go to our own Asbury 6. So here we are at asburyresearch.com. And by the way, if you have any questions about any of this, you can contact us right here through the contact tab. But let's go into the Research Center, and let's go to the Asbury 6. And what we're going to see here is that there's a lot of red. And when the Asbury 6 is red, 4 or more of these 6 constituent indicators indicate a negative bias for the Asbury 6 itself, a bias for the model. So this turned 4 or more of these flipped to negative on December the 16th. That is right here on the chart. So you can see this is going back about a year, past 11 months. And green is when 4 or more of the Asbury 6 are positive, or a green cell here. And the red is when 4 or more are negative. So we are negative. So we went positive on the Asbury 6 at the beginning of November, and we went to negative here. What does that mean? It means that the market internals that we have back tested as a set to tell us when the market is starting to lose its technical strength, its internal strength. We look at stuff like volatility, investor asset flows, breadth, relative performance between stocks and bonds, and a couple more in there too. They told us the market was starting to weaken internally. Why do we use this instead of just looking at the S&P 500? Because the S&P 500 isn't a really good day-to-day indication of what the market feels anymore. It's up 50 today, it's down 50 tomorrow. There's a lot of noise in the S&P 500. In order to bypass the noise, we are going back to a short list of back-tested tactical tools that have been very useful to me during my 40-year career in the markets. So right now, this is telling us that the market is vulnerable to more weakness. What would make me feel better about the market? 4 or more of these would have to turn to green. We've got a long way to go before we see that. The next thing I want to look at is I just want to spend a moment on sector rotation, because we do a lot of sector rotation here and we think it's really important. We're going to go to our CEF model, which is our sector rotation model. And you can find out more about these models. I'm not going to go through that here. If you go to research and click down, you can see all of our models here. There's more information for you if that's what you want to do. But for now, I just want to let you know where the money is going the fastest and where it's coming from according to sector rotation. So here's our CEF model. Through the end of last week, you can see the top 3 ranked sectors are communication services, XLC, consumer discretionary, XLY, and technology, which is XLK. That's where the money is going right now. You can see there's some short-term money that's starting to go into healthcare here, which is a defensive sector. It could be that there's starting to be some defensive feelings in the marketplace, and they're starting to maybe start to hedge a little bit by some defensive areas, as these top 3 here are all pretty much offensive sectors. Down at the bottom, the weakest, where the money is basically coming from to go to those top 3 sectors, is energy, staples, and also materials, XLB. The next thing that I want to look at is the S&P 500. I want to see where the support is. So we're going to go back to Stockcharts here, and we're going to take a look at the S&P 500. So here's how we think this is going to game out. We've got big support down here from 56.70 to 56.52. There's those highs again from July and August of last year. And we also have a trend line coming up from October of 2023 coming through here. So there's a lot of convergent support levels just about 50 points below the market, about 150 points below the market. We're at about 50, where are we? We're at 58.22 right now. So about 150 points below the market. Below that is a 200-day moving average. That's the major trend proxy that I don't think you can watch financial television for more than 5 minutes and not hear someone talk about it. The market sees it as the kind of where the trend is. So as long as we stay up above these supports, we are still in a bull market. We're still in a strategic bull market. But right now, we're in a correction. How do we know we're in a correction? Because our Asbury 6 has turned red, and also our CPM, which is our correction protection model, that is also risk off right now. So we have 2 indications right now that the market is vulnerable to further weakness. On the top side, if this correction is indeed going to go deeper, and we're going to get down and test these support levels, 59.52 is an important place to watch. The resistance level, it's the convergence of the 50-day moving average, which a lot of people look at as a minor trend proxy, and also the 21-day moving average, which is Asbury Research's tactical time period. It's a business month. So underneath 59.52, based on the price of the S&P 500, we're still in a correction. If we are still in a correction, this is likely we are going to test to see if the major trend is still intact. The next thing I want to do is take a look at the leadership. Where's the leadership coming from? The market needs some leadership if it's going to recover here. The first place that we're going to look is large cap tech, because that's what drove the market higher last year, largely by itself. So we're going to go to the INDX right here. That's the Nasdaq 100 largest stocks. And what we see here is up top here, we've got a daily chart that goes back to June. You could see we're testing support here from the July highs at 20,691. We're sitting right on top of it. That's where this trend should re-engage if it's still intact. If we break through here, however, the next level is about 5% lower down at the 200-day moving average, and that's at 19,611 right now. So if we can't hold 20,691, again, that's where your leadership's coming from, vulnerable to another 5% move lower. Here's what I don't like about this chart, is it's been underperforming. This is relative performance now of INDX versus SPY, and it's 63-day moving average, which is a business quarter. Notice how it's been underperforming since the middle of December. The middle of December is when the market peaked. That's when you lost your leadership from INDX. So again, if INDX keeps underperforming the S&P 500 and we break 20,691, the likelihood that we've got more of a correction to go becomes much greater. Now let's take a look at volatility. Let's see how the market's feeling. Is the market afraid? Is the market calm? We're going to go look at the VIX. So here is the VIX on top. The CBOT Volatility Index. Up top here, daily going back to September with its 21-day moving average. Again, that's our tactical time period here at Asbury Research. We've got the S&P 500 down here on the bottom. When the VIX is above the 21-day moving average, as it's been with few exceptions for the past 3 weeks, that means the market is getting fearful. Well, fear up here, complacency down here. When the market is underneath, when the VIX is underneath the 21-day, the market typically goes up. The market's feeling comfortable. When the VIX starts to rise above the 21-day on a very short-term tactical basis, it means the market's getting frightened. That's what's going on here. 1734 is where the 21-day moving average is right now. As long as the VIX stays above it, the likelihood is extremely good that we're going to see more downside pressure. Next thing I want to do when I'm kind of stress testing the market here is I want to see how it's doing versus bonds. When stocks outperform bonds, that's typically happening during a bull market in equities. When stocks are underperforming, it means the market is shifting to safety, shifting to bonds, and that's typically not good news for the stock market. So here is the S&P 500 up top. This is daily again going back to September. This is the relative performance of SPY versus AG. AG is the ETF for the aggregate bond index. Note what's happened here. Since September, this relative performance, SPY had been outperforming AG on a 21-day basis since the middle of September, right about here. And with few exceptions, it stayed there. It fed all of this, or it was an indicator of stock market strength and coincided with this nice move higher. Well, look what's happening now. That trend is stalled. SPY and AG are kind of going back and forth and push me and pull you on the 21-day moving average, starting to roll over. If SPY continues to underperform AG, if it continues to underperform AG here in the weeks ahead, we're going to see more weakness from SPY and from the S&P 500. So the last chart, well, there's two more charts that I want to show you. One is seasonality. So this is seasonality in the S&P 500. This, again, is part of Stockcharts. This goes back for 5 years. And note that we have generally a weak January. Things get a little bit better in February, and then we're strong in March, May, and in July. So basically spring and summer, things start to look a whole lot better. But January is typically weak. That's another reason, in addition to these other charts that I've showed you with relative performance and volatility, that the market is vulnerable to a little more weakness here. Finally, the last one we're going to look at is, let's go back to our charts. I'm going to take a look at long-term interest rates. This is TNX, which is CBOE 10-year note index. It emulates the yield of the 10-year. It's a blend of 10-year Treasury notes in multiple maturities. Important takeaway here is back during December, the yield of the 10-year broke this important trend line that went all the way back to the peak that it made in November of 2023, right around 5%. So 4163 is where the trend line is. That essentially is the same as the 416 yield, a 4.16 yield in the cash 10-year note yield. You can see the 50-day moving average is right there. So we tested it here in November, failed. We broke it in early part of December, and we went straight up to that old high that we made back in April of last year at 47.37. That's about a 474 yield. Now we've broken through there. What does that mean? It means that the next resistance level for yields is 49.97 in the index, which is a 5% yield. So now, let's call it 474 in the actual yield. That's where the support is for yields. As long as it holds that support, we're going to probably revisit 5%. Why does that matter? It's because higher interest rates are typically a drag on the economy. They're a drag on the equity market. So the way this is setting up for me right now, and again, it keys off of the CPM, the correction protection model, which we didn't look at today, but we looked at the Asbury 6. The benchmark S&P 500 is in the midst of a tactical correction that began in the middle part of December, according to both the A6 and also our CPM, and it closing in on major support. INDX and comp both have met their 2024 upside targets. I talked about the one in the comp when I was with you in October. INDX is also testing some pretty important support. Volatility is rising. Stocks are underperforming bonds. Seasonality is negative, and long-term interest rates are rising. All of this corroborates the technical weakness that we're seeing in the Asbury 6. Our firm is going to remain defensive and risk off as long as our Asbury 6 and CPM continue to indicate that the market is internally weak and vulnerable to a deeper decline. Now, just a little bit about my firm, Asbury Research. We offer 2 tiers of investment research for professional and individual investors. We have a premium product that includes all of our models and model portfolios, and we also have a free newsletter that you can find on Substack. It's asburyresearch.substack.com if you'd like to visit there and have a look. We also offer asset management that includes 4 different model portfolios. You can find us again by going to asburyresearch.com and using the contact tab here, again, with any questions on what you saw today. I hope this was useful to you, and we will see you at my next video for our friends at Stockcharts.com, hopefully in about 4 to 5 weeks. Thanks for watching, and have a great first quarter.